What is called expense ratio in mutual funds? How important is expense ratio in choosing investment? To help you deal with such investment challenges, we have our investment expert Mr. Hariharan with us. Hariharan, the stage is all yours.
So what is this expense ratio? It is nothing but sum of certain fees that are charged. So we have the fund manager fee, we have got audit fee, legal fee. Then the fund also does a lot of distribution, marketing work to promote the scheme. So those fees is also charged. So all of these sort of becomes the total expense for the fund. That divided by the AUM of the fund gives us the total expense ratio. Now, how do we evaluate this? How do we analyze this? How do we use this? Now, for equity schemes and for non-equity schemes, which is debt schemes, this is graded. When I say graded, these are SEBI guidelines in terms of what is the assets under the management of that scheme. So, as your assets under the management keep rising in that fund, the expense ratio keeps coming down, right? So for example, if you have a very new fund which has just come, obviously it will be 0 to 500 crores. You pay a higher expense, which is 2.25% in equity schemes, 2% in debt schemes, and every where you see that it is coming down by 0.25% as the assets under the management increases. So this is what one can look at. Again, my personal view is that you should not get too much into all of this, but just for academic interest. And if you are very conscious that, I want to sort of save a few bips of money or percentages of money, you can look at it. But it's good to know that there are expense ratios and what does this expense ratio cover, right? Few couple of important things is that we need to know that at the end of the day, this is a cost that you pay, okay, for the fund manager to generate that extra reward or percentage returns, right? And therefore, one would want to take a fund which is lower in terms of the expense ratio. But again, don't fall prey to the fact that this fund has the least expense ratio in the category. Let me just blindly go and invest. No, that should not be the criteria. Relatively, you will have to check so far in terms of risk adjusted parameters, fund manager consistency, all of that has to be looked at together before you just look at expense ratios. But this is just for your academic interest. Two important point is that there are regular plans, there are direct plans available, and therefore there is a difference in expense ratio between direct and regular. Again, just because the direct plan is cheaper does not mean that you should blindly go and invest in a direct plan. That is what happens typically with a lot of do-it-yourself investors. Again, the objective is not to save that 50 paise or etc. It is important to stay invested, and that is where the role of a distributor and advisor becomes very, very critical. Actively managed funds will have a higher expense ratio as compared to passively managed funds. When I say passively managed funds, we have index funds, we have ETFs, which is exchange traded funds, where the fund manager will just replicate or copy the index, and therefore the fund management charges are very low. Now, expense ratio, typically, if one were to look at it, has a lot of significance in debt mutual fund rather than equity, because equity anyways, one would expect to generate 12, 14, 15% returns, and 0.5% extra does not make too much of a difference. But in a debt mutual fund, where the returns typically would be single digit returns, typically, maybe that 0.5, 1% of expense ratio can make a difference. All right. So relatively, again, this is relative to equity versus debt. I think expense ratio has more significance in debt as compared to equity. Again, typically this is used by institutions, where they want to look at the expense ratio, and therefore they choose a direct plan. So corporates invest thousands, 10,000 crores of money through their treasury. So they look at direct plan investment rather than doing it through an intermediary, because for them that quantum is reasonably high. Right? But from an individual level, I think it doesn't make too much of a difference. Maybe specifically for the debt fund, it might make some difference.
Thanks for your detailed answer.
If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.